The year 2024, a pivotal moment for the global economy. We're emerging from a period of turbulence, but the path to recovery is proving to be more winding than many anticipated. Growth is returning, yes, but it's a slow and steady climb, not the explosive rebound some were hoping for. A time for economies to catch their breath and rebuild. So, what does this mean for the major players on the world stage? What's the outlook for inflation, that silent thief in our wallets? And how will the roller coaster of financial markets react? Join us as we journey through the complexities of the 2024 global economy. We'll explore the challenges and opportunities facing giants like the United States and China, and also navigate the intricate landscape of Europe, and finally uncover the hidden potential of emerging markets. Let's turn our attention to the United States, the economic powerhouse of the world. And guess what? Things are looking pretty good. The US economy is roaring into 2024 with an impressive growth forecast of 2.7%. That's a solid improvement. This surge is fueled by two key factors. First, we've got resilient consumer spending. Americans are out there shopping, dining, and fueling the economic engine. Second, we're seeing a robust labor market. With unemployment rates at historic lows, more people working means more money flowing through the economy. But, as with any economic story, there's a bit of a plot twist. By 2025, this growth is projected to ease back to 1.9%. Why the slowdown? It's all about the Federal Reserve's moves to tighten monetary policy. Remember those interest rate hikes we've been hearing about? Well, they're starting to take effect. Higher interest rates mean borrowing becomes more expensive. Think of it like stepping on the brakes of a car. It's necessary to avoid overheating, but it does slow things down. This can put the brakes on spending and investment, cooling down the economy. So, while the US economy is enjoying a bit of a sugar rush right now, that energy is expected to taper off as the impact of those rate hikes fully kicks in. It's a bit like a roller coaster, a thrilling climb followed by a gentle descent. But don't worry, the US economy is fundamentally strong, and this slowdown is simply a natural adjustment after a period of rapid growth. It's going to be an interesting ride. Now let's shift our focus across the Atlantic to the Eurozone. Unfortunately, the economic outlook here isn't quite as sunny. It's like stepping out of a warm, vibrant summer day into a chilly autumn morning. The Eurozone's growth is projected to be sluggish, crawling along at just 0.8% in 2024. It's a bit like a car trying to accelerate uphill with the handbrake on. Two major factors are contributing to this economic sluggishness: the lingering sting of high energy prices and a pervasive sense of unease among consumers. Europe is still grappling with the aftermath of a significant energy crisis. It's like a hangover that just won't quit. High energy bills are squeezing households and businesses, leaving less money for the fun stuff: dining out, vacations, investments. On top of that, consumer confidence is shaky. People are hesitant to open their wallets, creating a ripple effect that dampens economic activity across the board. The Eurozone faces a unique set of challenges. It's not just about boosting growth in the short term, it's about tackling these deep-rooted structural issues that are acting like anchors, holding the economy back. The question is, can the Eurozone find the solutions it needs to reignite growth and overcome these persistent hurdles? It's like a complex puzzle waiting to be solved. Only time will tell, but the road ahead is certainly not without its twists and turns. China, slowing down and why it matters globally. China's growth is also slowing, though it remains stronger than most advanced economies. In 2024, China is projected to grow by 4.6%, down from 5.2% in 2023. While this might seem like a minor dip, it's part of a larger trend of deceleration in the Chinese economy. One of the core reasons for this slowdown is the need for a comprehensive restructuring of the country's massive property sector. China has long relied on property development as a key driver of growth, but now, with issues in domestic demand, there's a clear need for a shift in strategy. And because China plays such a pivotal role in global trade and supply chains, Its slowdown is something the entire world will feel. Meanwhile, India continues to shine. With the IMF forecasting a 6.8% growth rate for 2024, India stands out as a beacon of strength, particularly among emerging markets. This rapid growth is driven by strong domestic demand and robust investments. India's economy is benefiting from its younger population and a growing middle class that's increasingly spending on goods and services. In contrast to the more mature economies, India still has plenty of room to expand, which is why it's becoming such an attractive market for investors. As long as India can maintain this momentum, it will be a key player in the global economy. Inflation is easing, but not gone yet. Now, let's talk about inflation. We've all felt the impact of rising prices over the past few years, but there's good news. Inflation is starting to ease. In the United States, it's already down to 3.5% in 2024, a massive drop from the 7% we saw in 2021. The IMF expects inflation in advanced economies to average around 2% by 2025. However, inflation isn't something that just disappears. It's a slow-moving process. Even as price pressures ease, central banks will continue to monitor the situation closely to avoid any unwanted spikes. Monetary policy, the shift begins. With inflation easing, central banks are starting to shift their approach. In the United States, the Federal Reserve is expected to cut its benchmark interest rate by 75 basis points, bringing it down to 4.6% in 2024. This move will help stimulate the economy by making borrowing cheaper, but it's a delicate balance. Lowering rates too quickly could reignite inflation, while being too cautious might slow growth even further. The world's central banks will need to walk this tightrope carefully in the coming years. Market outlook, volatility, and caution ahead. So, what does all this mean for financial markets? 2024 is likely to be a year of modest returns and continued volatility. JP Morgan projects that 10-year Treasury yields will hover around 4.25% by mid-year, then drop to 3.75% by the end of 2024. This signals a slight cooling in the bond market, but it's still a far cry from the ultra-low rates of the past decade. On the equity side, moderate growth is expected, though this will largely depend on how economic conditions unfold and what happens on the geopolitical stage. Investors are advised to stay cautious and closely monitor developments, as unpredictable events could still shake the markets. Conclusion: a cautious path forward. In summary, 2024 is shaping up to be a year of steady but modest growth for the global economy. The United States is leading the way, though its growth will taper off, while Europe and China face unique challenges that are slowing their recoveries. India, on the other hand, continues to be a bright spot. Inflation is easing, but central banks must be careful not to act too quickly or too slowly. And financial markets, as always, are expected to remain volatile. For investors, caution and informed decision-making will be key in navigating the year ahead. The information provided in this video is for educational and informational purposes only and does not constitute financial advice. Thank you for watching. If you enjoyed this content, please consider subscribing and leave your comments below. See you in the next video.